Charles Plosser, former Federal Reserve Bank President of Philadelphia. Nice to see you at Camp Kotok.
Great to be here.
Are you happy that you are not on the Fed at the moment?
Well, no, it was a fascinating and interesting experience, and I wouldn't trade it for anything. But, you know, there's lots of work left to be done for the Fed.
Does the work begin with a rate increase in September?
Well, I think at the end of the day, we've been through this extraordinary period. Monetary policy has been highly accommodative, very aggressive in many ways. And so we've perhaps accomplished a lot, and we can debate about to what degree the Fed contributed to the success. But now we've got to undo all this. And so I think there's many challenges that still remain for our central bank.
So how do we undo it beyond the traditional way, and that is, of course, to raise rates? But now we've had all this liquidity that's sloshed into the economy. Is it going to be the most difficult task the Fed has ever done?
Well, I'm not sure about that. The Fed has faced many challenges, but it's going to be difficult. We're in uncharted territory. This is something we've never done before. Central banks rarely have done. So I think there's going to be some learning along the way, and we'll have to see what techniques or strategies are going to work most effectively. But it's going to be a challenge. So it's kind of not over yet, and we'll have to see whether the Fed can manage its way out of this in a manner of its own choosing, or whether it's stuck reacting to market pressures that are going to dictate to the Fed how it has to proceed. So some people are worried that the market may get ahead of the Fed, and the Fed will have no choice, for example, but to raise rates very aggressively or very quickly. And they may not choose to do that, but they may have to. So I think it remains to be seen about how this will play out.
Do you think the Fed has done a good job trying to prepare the markets? Because certainly it is a more open Fed than we saw years ago.
Well, I've always been a big fan of transparency. I think that transparency is important, and you try to communicate. Whether they've done a good job, you know, we'll have to wait and see. But I just think it's going to be a difficult task.
Isn't it interesting, too, that we're kind of long in the economic cycle? People are concerned that we've actually had a recovery. It's been anemic. So what if the Fed starts pushing rates higher, and then we see the economic cycle take another downturn?
Well, then you lower rates back down. I mean, good things happen and bad things happen. If rates go up, rates go down. So if bad things happen, you know, you have shocks that cause the economy to sort of deteriorate, and the Fed has to lower rates after having raised them. I don't see that as necessarily a bad thing. That's what monetary policy does. So I don't see that. People are afraid of that, but I don't see why we should think of that as sort of a bad thing necessarily.
This hasn't happened in a long time, and it rarely did happen, and that is an intermeeting move where the Fed makes a move and it's unexpected. Do you think those days are over?
Well, you know, no, I don't necessarily think those days are over. Unexpected things happen, and sometimes they're important enough for the Fed to make a move. But I think what the Fed needs to do, and I've been a big proponent of this, is to signal more about how they'll react in different circumstances. You know, articulate their reaction function, articulate how they respond to economic events. But economic events can surprise us. And so when they surprise us, you'll get surprise actions from the Fed, which I think is entirely appropriate, and I don't think you can avoid.
What do you think the centerpiece of the discussion is behind closed doors these days? And there'll be another meeting coming up, but what is the main, do you think, point of contention?
Well, you know, I think everybody is worried about, you know, how fragile is the economy. You'll hear that conversation a lot. I actually think it's not that fragile, but I think what we've seen is a pretty robust, steady, reliable growth rate. Not high, but pretty consistent. So some people are going to be worried about, well, you know, are we doing it too early? Some people are going to be worried about inflation, which I think is a fair concern, but frankly, inflation's really not that low. I mean, we had inflation of less than 1.5% for much of the 50s and early 60s. The world didn't fall apart. So I think that some people are looking for more inflation or more assurances that inflation is going to move back to 2%. Other people want to see the unemployment rate go lower or labor markets improve. So those will be the focus of attention and sort of how comfortable the committee members are with the state of the economy. But on the other side, there are going to be others who are very concerned about financial stability, and they're going to worry about the potential unintended consequences of, a ninth or eighth, whatever year we're in of zero interest rates, whether or not we're going to regret that at some point down the road.
Due to an asset bubble?
Well, asset bubbles are just distortions that get created in one form or another. I mean, the Fed has tried through its QE processes to move people into riskier assets and incentivize them to do so. But at some point, those incentives that the Fed's providing have to be removed, and you get movements back in the other direction. So I think there's a lot of concern in the committee about the consequences of such a prolonged period of zero interest rates. And I think there are a lot of people who would like to see us get away from zero, just as a matter of principle. And I think that's not a bad idea. And the longer it goes on, I think the more uncomfortable some people become.
Any guesstimate on where the Fed funds rate will be 1 year from now?
Oh, no. It's data dependent, as they say. It'll depend on what happens. We'll just have to see, as the economy continues to grow and how nervous people are as rates begin to rise, and sort of what happens in this concert. But I would remind everybody, the financial markets are deeply involved in this, as you can imagine. And the financial markets told us that when the Fed was going to stop buying assets, long rates were going to go up. It was going to be a disaster. You can't do this. Well, what happened when we stopped buying? Long rates went down. Nothing happened. So I think we got to get away. I think financial markets should get away from this notion that everything the Fed does is so important. Lots of things go on to determine the path of the economy that have nothing to do with the Fed. And we need to get used to that.
We'll end it there. Charles Plosser, thank you so much.
Thank you very much, Ron.